Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Albemarle Corporation Annual Report. Albemarle Corporation offers a diverse range of businesses and services worldwide. At the core of its operations is the energy storage segment, which provides lithium compounds for use in various applications such as electric vehicles, power grids, solar panels, and consumer electronics. This segment also offers technical services and recycling services for lithium-containing byproducts. In addition to energy storage solutions, Albemarle's Specialties segment provides bromine and highly specialized lithium solutions for industries like energy, mobility, connectivity, and health. The company offers a range of products including fire safety compounds, brominated powdered activated carbon, and cesium products for the chemical and pharmaceutical industries. The Ketjen segment is focused on clean fuels technologies, offering hydroprocessing catalysts, fluidized catalytic cracking catalysts, and performance catalyst solutions. These services cater to various industries such as grid storage, automotive, aerospace, conventional energy, electronics, construction, agriculture, food, pharmaceuticals, and medical devices. Overall, Albemarle Corporation's businesses and services span across multiple sectors, providing a comprehensive range of products and solutions for various applications. The stock price of Albemarle Corporation has skyrocketed by over 125% in the past year due to a combination of factors. The most significant driver was the substantial recovery in lithium prices, which increased by 51% over 1 month and 85% over the past year. This rebound was attributed to renewed market discipline among producers, who cut production and closed high-cost mines. The strong demand for lithium from electric vehicles and energy storage systems also contributed to the surge in Albemarle's stock price. Industry forecasts suggest that lithium demand is expected to more than double by the end of the decade, with 2026 being a critical year where demand growth is projected to outpace new supply. Albemarle's internal restructuring and cost-cutting initiatives also played a crucial role in its success. The company implemented aggressive cost reduction measures, optimized its lithium conversion network, and reduced capital expenditures. These actions significantly improved the company's free cash flow and overall financial health. In addition to these factors, Albemarle's strategic asset sales and divestitures generated cash proceeds and sharpened the company's focus. Several financial analysts also upgraded Albemarle's stock and increased their price targets in late 2025 and early 2026, reflecting an optimistic view of the company's future. The company's better-than-expected earnings performance further boosted investor confidence. Albemarle reported stronger-than-anticipated earnings, particularly a surprise-adjusted profit in the second quarter of 2025, outperforming analyst predictions. The fourth quarter 2025 results also showed increased net sales and adjusted EBITDA, further contributing to the surge in its stock price. Overall, the combination of a rebound in lithium prices, strong demand for lithium, Albemarle's internal restructuring efforts, strategic asset sales, positive analyst upgrades, and better-than-expected earnings performance have all contributed to the significant increase in Albemarle Corporation's stock price over the past year. Albemarle Corporation market capitalization of $21 billion is significantly larger than the average industry peer of roughly $2 billion. This shows that Albemarle Corporation holds a significant advantage in their industry. Albemarle Corporation trades at a higher price-to-book ratio of 2.66 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 39% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be categorized into several key areas. Market pricing, particularly for lithium, plays a significant role in influencing revenue. Changes in market prices can either boost revenue through increased sales or decrease it due to lower demand and prices. Customer demand is another crucial factor that affects revenue. Fluctuations in customer demand can lead to either revenue growth or decline. Operating and production costs also have a direct impact on profitability and revenue, with increases or decreases influencing the bottom line. In terms of specific drivers, increased sales to unconsolidated affiliates and reduced capital intensity through restructuring efforts can contribute to revenue growth. On the other hand, decreased sales to unconsolidated affiliates, increased purchases from them, and project cancellations due to unfavorable market conditions can lead to revenue decline. Other factors such as depreciation and amortization expenses, non-cash goodwill impairment charges, and changes in stock-based compensation also impact revenue. Understanding these drivers is essential for businesses to make informed decisions and navigate the complexities of revenue growth or decline. The net income of the company underwent significant changes between 2023 and 2025. Initially, it decreased by 26% in 2024 compared to 2023 due to various factors such as fluctuations in foreign currency exchange rates. However, there was an improvement in 2025, with a decrease in losses from $1.76 billion to $552 million, indicating a reduction of $1.21 billion in losses. The profit margins also experienced changes during this period. Despite decreasing from -10.2% in 2024 to -0.8% in 2025, the company's profit margins showed an increase from 0.1% in 2023 to -0.8% in 2025. This change can be attributed to a decrease in the effective income tax rate from 174.4% in 2023 to -4.9% in 2024 due to various factors such as changes in valuation allowance and release of foreign valuation allowance. The reasons behind these changes are multifaceted. Decreased demand for lithium, increased competition within the industry, and higher costs associated with capital expenditures contributed to decreased net income and profit margins. Additionally, low lithium prices, fluctuations in raw material and energy costs, and inability to pass through price increases to customers also played a significant role in this decline. The company has demonstrated a consistent ability to generate positive operating cash flow over the years. In 2023, it reported a significant amount of $1.3 billion in cash provided by operating activities. This trend continued in 2025, with net cash provided by operating activities reaching $1,282,267 and operating cash flow totaling $114.2 million. These figures indicate that the company is successfully managing its operations to produce positive cash flows, a crucial indicator of financial health. The company's debt level and interest expenses have undergone significant changes over the past year. According to the extracted summaries, total long-term debt decreased from $3,516,165,000 in 2024 to $3,193,541,000 in 2025, indicating a reduction of approximately $322 million. However, this decrease is offset by an increase in debt level due to the issuance of new notes. In terms of interest expenses, there are conflicting information across different pages. While page 20 suggests that interest expenses increased due to a downgrade of credit rating and higher applicable margin for borrowings, page 64 indicates a decrease in interest expense from $22,668 to -$25,359 NM. Nevertheless, the change in interest and financing expenses from 2024 to 2025 shows an increase of $42,032,000. Overall, while there are discrepancies in the data, it appears that the company's debt level has decreased slightly, but its interest expenses have increased. The potential for higher borrowing costs due to high or increasing interest rates remains a concern for the company. The financial performance of the company varied across different segments, regions, and locations. The energy storage segment and lithium specialties business within the specialties segment performed well, with expected increases in net sales and profitability due to strong global demand. However, other segments struggled. The Ketjen segment's refining solutions business was divested or underperformed, resulting in non-cash goodwill impairment charges and long-lived asset impairments. Within the specialties segment, overall performance was expected to decline due to lower pricing and reduced customer demand in certain markets. Additionally, the JBC joint venture within this segment experienced decreased earnings due to lower pricing. Geographically, Asia, Middle East, and South America regions performed poorly. Specific locations such as Western Australia faced challenges with the Kemerton Train 3 construction stoppage and Kemerton Train 2 put into care and maintenance. China also struggled, with the Chengdu conversion plant being placed in care and maintenance. Management is signaling a mixed outlook for the company. On one hand, they are making significant investments in various projects through acquisitions and integrations, indicating a focus on growth and expansion. They are also allocating equity in net income from unconsolidated investments to each segment, suggesting a focus on segment-level performance. However, management statements also convey uncertainty about the company's future prospects. The outlook is described as uncertain, with significant fluctuations in net income attributable to Albemarle Corporation. Additionally, the company is divesting certain businesses and restructuring operations, which may indicate challenges or difficulties in some areas of the business. Despite these uncertainties, management is committed to investing in sustainability and environmental initiatives, which could have long-term benefits for the company. They are also aiming to reduce costs and enhance financial flexibility through restructuring efforts, which should help improve the company's bottom line. Overall, management statements suggest a cautious approach to growth and expansion, with a focus on managing risks and improving financial performance. Acquisitions and divestitures overview. Albemarle has made several significant acquisitions and divestitures in recent years. On the acquisition side, the company acquired a 50% interest in Wagena for $380 million. Additionally, Albemarle restructured its MARBL joint venture, reducing its ownership percentage from 60% to 50%. The company also acquired the remaining 40% ownership of Kemerton Lithium Hydroxide Processing Facility in Australia. In terms of divestitures, Albemarle has sold several businesses and assets. The company sold its Ketjen's refining solutions business to ChemCat Acquisition Co., LLC for an undisclosed amount. Additionally, Albemarle completed the sale of its 50% ownership interest in Euricat SA, a joint venture included in the Refining Solutions reporting unit, to Axens SA for approximately $123 million. The company has also announced plans to sell its controlling ownership interest in the remaining Refining Solutions business and place several facilities into care and maintenance. 2 divestitures are expected to close in 2026, with cash proceeds of approximately $660 million. These transactions demonstrate Albemarle's efforts to optimize its portfolio and focus on core businesses. The company has a history of paying dividends to its shareholders. According to the extracted summaries, the company declared and paid various amounts in dividends, with one notable instance being the reduction of mandatory convertible preferred stock dividends by $166.8 million in 2025. Additionally, the company paid out $187.2 million in dividends to its shareholders. On the other hand, the company's share buyback activities are less frequent. Although a share repurchase program was authorized for up to 15 million shares, no shares were actually repurchased in 2025, 2024, or 2023. This suggests that the company has not actively engaged in buying back its own shares in recent years. Supply chain disruptions and inventory buildup concerns. There are significant concerns about supply chain disruptions in the industry. Several pages highlight potential risks, including the inability to secure key raw materials, transportation and shipping costs increasing or being inhibited, and delays in obtaining or renewing contracts. Additionally, tariffs on Chinese electric vehicles and lithium-ion batteries have resulted in shifting trade flows and restrictions on certain sales of goods into China. Climate-related impacts and geopolitical events could also limit the supply of key raw materials and impact pricing. The Middle East situation has already caused shipping and raw material delays, and further disruptions are possible due to geopolitical climate volatility. These concerns are reflected in the industry's experience with volatility and increases in raw material and transportation costs. In contrast, there is limited concern about inventory buildup, with several pages mentioning no such issues. However, it is worth noting that some pages do mention potential decreases in inventories from 2023 to 2025, which could indicate a shift towards more efficient supply chain management. Overall, the industry must be prepared for potential disruptions and volatility in the supply chain. That concludes the financial summary for Albemarle Corporation. Feel free to comment below, and I will be happy to answer them when possible.